Hey everybody, Tom Gentile here. Happy Monday to you, Monday, April 13th. Welcome to Patterns and Profits, where you know what we do here. We discover patterns that repeat and profits that add up. I am your resident pattern trader, Tom Gentile here with, I got a pretty packed show here for the time we're going to be together. I want to talk about updates from Iran, what's going on there. We're going to dive into the area that most people miss. All right. I'm not going to sit here and talk about the news. For those of you brand new, I don't talk about the news. What I do is go where others drop off. And what I'm talking about is we're looking for patterns. We're looking for patterns that repeat themselves over and over again. And my area is either in seasonal patterns or in volatility patterns. All right. We'll talk about each of them here on today's program. So I want to talk about updates from Iran. I want to talk about options pricing and what's been going on in the oil markets that a lot of people are missing. And then finally, Meta has come on the radar. All right. Meta's come on the radar. So I want to do a deep dive with Meta. I want to look at the seasonality of Meta. I want to look at the options of Meta, and I want to talk about our 3-point play. All right. Yeah, we're coming out of March Madness, obviously. But I want to talk about the 3-point pattern that we use when it comes to trading. All right. Again, for those of you who are brand new with us, if you're seeing me for the very first time, all right, a couple things you can do along with the old guard. All right. Comments, questions, etc. Put them in there. All right. We're going to get to as many as we can. And the other thing, too, is that if you like what you see here, consider subscribing and you can get free reports. I've got an oil report that is dropping right now that you can get. You have to go to patternsandprofits.com, right? Patternsandprofits.com to get that oil report. And I'm going to go ahead and put that in the description later on in the program, but you can jump right ahead, www.patternsandprofits.com. All right, let's talk about what everybody's covering, and then we're going to go where nobody's talking. And now I'm talking about oil, and I'm talking about what's going on in Iran. If you woke up this morning, all right, you know me, I take a look at what happens on Sunday afternoons. If you want to see what's going on, Sunday afternoons, about 6 o'clock Eastern time, you know, the world's waking up on the other side, and they are waking up to where they see the markets going. And of course, that is equates into our futures prices. And you can get that on a lot of platforms, a lot of option platforms, a lot of brokerage platforms will tell you what's going on Sunday night. You get a really good clue as to what's happening during the day. Here's what we saw as we were coming into the day. And this is, that we're seeing New York Times, Iran war, live updates, deadline passes for the U.S. blockade in the Strait of Hormuz. NBC News, U.S. blockade of Iran's ports comes into effect. Trump says that he blah, 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 and you got to click on it to see. And then, of course, Al Jazeera, Trump threatens Iranian ships as U.S. naval blockade begins. But that's not all. This is what we're seeing right now in the news. And then it just continues. You got the BBC. All right, the BBC saying that U.S. blockade of Iran ports takes effect as Trump threatens to destroy the attackers. CBS News, U.S. military blockade on Iran ports in the Strait of Hormuz begins. New York Times basically saying the same thing, but U.S. intelligence shows China's taken more active role in the Iran war. And CNN, Iran has a new demand to end the war. And it could bring in billions. And I haven't clicked on any of these because I don't. But from what all the talk was about over the weekend, it might be tolls. It might be the tolls that they're talking about that I saw come across the screen as I was watching the Masters tournament yesterday. That's what I had my eyes on during the weekend. But anyway, this is what everybody's talking about. This is what everybody is seeing, right? But let's talk about what nobody is seeing. All right. And we're going to step down. We're going to step down from what 98% of folks were seeing with their news to where maybe 10% of folks are looking at to what 1% are looking at. And that's what you and I are looking at here. So oil pricing, let's talk about what, what some folks did after looking at the news is let me look at a chart of oil. And the chart you're looking at is USO. USO is the oil ETF, mostly oil. There's a little bit of distillates in that ETF, but the majority of that ETF is crude oil, and it effectively is in the price of this chart that you see here. I've shown this to you before, but what I want to really kind of concentrate on is what has happened really in the last month. All right, month, 5 weeks, we've seen oil go from USO go from below 80, right, just below 80 to 140 before snapping back down below 120. And here we were coming in today above 130 once again. The interesting thing is when you look at this chart, it looks like an uptrend. It absolutely looks like an uptrend. And the fact that we didn't fall down, all right, first after the March 8th move, March 9th, where we opened very high and then we closed very low. There was a huge move there. It started overnight, right? But then what happened last week? We jumped again above 140 and then we closed lower. And within a day later, we were down, I want to say 18% within 2 days just last week. Since then, we have been climbing back up. And here we are Monday again over the weekend. And of course, a lot of that news is already been bumped into the price of USO and the price of oil. Now I want to take a look at this with eyes that very few people follow, and that is the options implied volatility. You know, if you're not an option trader, options can really help you. All right. They can really help you, even if you're not an option trader, give you a real good gauge on the volatility of the markets. You know, and you take a look at the volatility markets, you can see here, option implied volatility is the red line that I've put on top of the candlesticks. So you see this red line, the pricing on the right, where you see the 0.5 up to 1.25. This is the percentages of implied volatility that have been happening with oil, and more importantly with USO. Most of you, if you've heard of the term the VIX, right? That is the options implied volatility on the S&P 500. This is the options implied volatility on USO. That one instrument, and that one instrument has gone from down here around 30. So, you know, you see the VIX, and if you see the VIX was, I think the VIX was around just under 20 closing up last week. Well, USO was their VIX was around 30, right? That VIX went to 130. By the time we got into about a month ago, it was 130, and it has since dropped down. Even with the move higher today, coming into the USO's VIX, if we're going to call it that, implied volatility dropped down to around 80. So a couple of notes that I have on the chart that I want to make sure you get. Number one, the highs so far this year for USO's implied volatility was 1.3. The low for the year was 0.3. That was back in January. We have quadrupled in value. The time value on the at-the-money options has quadrupled between January and March. But since those March highs, it has dropped 1/3 in the last 30 days. Now, we may have not have seen the highs yet, but I'm not talking about VIX. I'm thinking we may not have seen the highs yet in USO, but we have possibly seen the highs. Probably, all right. The probability we've seen the highs in implied volatility for the year have already come in. Right now, I want to show you what this looks like in terms of options, because you might think, wow, if I bought options back here in January, they'd be worth a heck of a lot more today, especially if I bought options on the day we had this big jump up. Well, gosh, I mean, USO was trading between 100 and 124 on those days. It must be higher now because the price of USO has gone up. Well, this is where some of you, maybe we've all gotten this lesson before, unless you're brand new. We've all gotten this lesson before in options. Let me show you what's happened here since. So if you take a look at the USO options chain, this is the July options, the options that expire 3 months from now. little more than 3 months from now. And you can see here, even though USO is trading in the 130s, I took us all the way out to the 140s, which is where it was just a short time ago. And those call options at the 140 are trading very close to 12. And that 12 tells us that, that you've got to add 12 to that strike price. All right. So if you take a look at 140 plus 12, that's a 152 break even between now and July. That's on July 17th of 2026. But the real push that I want you to look at is I want you to look at a chart of those 140 calls. So here's the 140 calls, and I actually pulled this up looking at Robinhood, because you can set, with Robinhood, you can actually set a call option, and you can put it on your watch list. Then go to your watch list and click on it, and it opens up the chart. And you can bring the chart up, the options chart, for a day, a week, a month, 3 months, a year, or its actual max. I brought up the last month because what's happened to USO in the last month? In the last month, USO has gone from, again, it crushed through 100, got to 140, came back to under 120-ish, 118. Now it's back up into the 130s again. Look at that 140 call. Let's take it back through time here for a moment. So if you go back a month ago, USO, when it was trading at around it was trading around 115, right? At the time, the 140 call was trading at around 14 and a half, right? So USO drops to 109. That 140 call dropped down to $7.50. So even though USO only dropped by about 6 points, that call option dropped off by about 40%. All right, so we went from March 23rd all the way up to the 7th of April. That was just last week. And the 7th of April, when USO was at 142, that 140 call option was clocking in at $24.50. I want you to take a breath here and think about that. The stock, all right, the ETF was at 142. It was only 2 points in the money. Yet, that option, in order to buy it, you would have had to pay $24.50 last week. Now, last week, if you paid $24.50 when it was trading at 142, you would have needed to get to $164.50 by the July expiration. That's your break even at expiration day. It was 22.5 points above where the stock price was to break even. That's a lot of premium, right? But here's the important point. What's happened since then? We saw USO drop back down into the 120s, and now it's trading at around 132.15 as of this chart. Look what the option prices are going for, 14.58. What has happened? We've dropped 40% off the highs in just a week, and yet oil is only off 8%. So what has happened here? We've seen a big volatility crush because we got some news out, and some news was that we were possibly going to see peace talks. And now we come into the weekend and those peace talks have been delayed. And so what is the delayed? What's happened? Well, we jumped up in price again, but we haven't jumped back up to those 24.50 area. Part of that's because we're not at new all-time highs for USO, but at the same time, the volatility is still crushing as well, right? So I thought what I'd do is put all that together and look at this a different way. So if you like oil to the upside, buying the call options, not the smart move. They're still expensive, even though they're off a good bit. They're still expensive, if you really do like oil to the upside. And there's a long-term pattern that takes us out to July. That's why I put the July options out there. We actually took profits on some oil positions just a week ago. But if you really like this to the upside, you think there's going to be an extension in oil prices, instead of buying the call options and paying nearly $12 for them, what about putting a spread on where you buy the lower strike call, sell the higher strike call? You take in premium on that, and all of a sudden now your $12 position is only about $2. Now, yes, you're only going to have the ability to make the difference between strikes. So $2 can only become 5, which means your $2 investment could yield a maximum potential reward of $3, but that's 150%. Imagine what the price of oil has to do, or USO has to do, in order for you to get 150% on just the call options themselves. So, in closing, with this particular segment, we're going to continue to get news out of Iran. I think this is going to happen every single day, whether news is coming from Iran or news is coming from Trump via Truth Social, X, or mainstream media. So I think this resolution, it may be weeks before we see some resolution to this. Number 2, all right, if you take a look at oil itself. So oil itself, we know that oil has trending to the upside. USO is trending to the upside, continue to trend to the upside. It could continue to trend to the upside because what's interesting is the volatility has dropped, but the price has held pretty steady and it's actually moving higher with volatility down. Usually when we see those big volatility spikes, it says there's going to be a change in price, but we could see another move to the upside. We could see that retail move coming in, and it could happen this month. Regardless of that, option prices are simply too high when we look at buying them outright. So I am looking at this week, and I'm looking at the money calendar. I'm looking for something seasonal. I want to look at seasonality here. I want to talk about seasonality. I want to see what's going on here with the markets and what's happened with those. And, despite the rough start that's been happening here, the markets really ended up closing on a solid note last week. I mean, you take a look, we had some big moves. Stocks pushed higher. We start to see some more risk on appetite going on in the markets there. I mean, on the surface, it looks like last week was more of a stabilization week, but again, we go through the weekend and that's not what we see happening as now. We saw yesterday, futures were deep in the red, turning on the financial news overseas. You see that U.S. and Iran are taking that spotlight again. President Trump's talking about taking military action when it comes to the Strait of Hormuz. That's what's brought on the uncertainty coming into the week morning. So world's oil supply, a lot of the world's oil supply flows through that Strait of Hormuz. I mean, we've heard that America's oil supply does not, but a lot of the UK oil supply does. And that, you might think, well, why is that affecting our price? Because it's the outlook of the world supply as a whole. And so that's why we're seeing repricing of energy. We're seeing repricing of oil. We're seeing inflation expectations. We're seeing potential supply chain disruptions. So, beyond geopolitics, though, the markets are still dealing with these ongoing concerns and how they're going to affect interest rates and how they're going to affect earnings that are coming out and how they're going to reprice valuations. I like what happened coming into last week. I think we need to see where the beginning of this week begins to give us that setup. But for me, regardless of uncertainty, I still try to stick to the plan. And the plan with me is seasonality. So volatility, volatility is not gone. We know that definitely coming into this week. It's just waiting for that next catalyst to unfold. That's what we see when we come into these markets. And so when I look at the bullishness here, I see, well, okay, so we're still 91% bullish on all the type of stocks that I look at. And that's coming into the beginning of the week. When you get to the end of the week, it drops off a bit. We see 89, 86, 87 going into Friday. But still, overall, I see a lot of bullishness as we're coming into the middle of April. Probably the only thing that I see that might be a little bit of a potential stab against the bullishness is guess what happens in the middle of the week? April 15th. It's tax day. And for many of us, tax day means that we've got to have our taxes set up and put in either through ourselves. We self-deliver taxes. Maybe we use accountants. And for many of us, it's extension day. So depending on where you are, you might be putting it off, but a lot of Americans, a lot of folks look at this, and that is a negative day. So, if you go back and you look at tax days, typically after the 15th, you start seeing that problem is behind a lot of us. And so that removes a lot of uncertainty. We're certain we're getting a refund, or we're certain we're paying some taxes, but the unknown becomes known. And when the unknown becomes known, that often breathes a sigh of relief. And so we might see seasonality get better just because of that. All right. Taking a look forward, there were 5 really interesting spring breakout stocks to start this week. And the top 4 I blurred out. Now, I'm going to be posting a video later this week that's going to reveal my spring breakout stocks going through this spring. All right. But I want to discuss one that didn't make the list that's down there near the bottom. Still a good stock. But if you want those three, then consider subscribing to the channel, Patterns and Profits, or at Patterns and Profits. That's our channel. And then, of course, you can get the full report. If you want the full report, then log in and sign up. It's free, patternsandprofits.com. All right, spring breakout stocks. Like I said, there's several of them up here. There's a couple 100%ers on here, but I want to look at Meta. I want to do a deep dive on Meta with you for the rest of our time together today. So take a look at Meta. I took a look at Meta, and it is definitely breaking out into spring and even into summer. So this is a 10-year table, if you will, of Meta. And what does this table tell me? Well, I've ran this through the money calendar. I've ran this through our seasonality. And what I see is that 9 of the last 10 years, right, Meta stock has gone up by an average of almost 15%. 15%. So we ran this all the way back to 2016. And you can see 2016, spring into summer, 6.73%. 2017, 5.7%. 2018 was 20%. 2019, a little more than 10%. We saw 2020 jump by 36%. Remember, that was the year a lot of stocks jumped up after the Q1 blues of COVID. 2021 was up 12%. 2022 was a bear market for most of the market, and this one dropped 21%, but then it came right back. 23, 24, and last year, 36% move on Meta. We know when you think of Meta, think of Facebook. All right. Facebook has, is the big driver of Meta. What has Meta been doing over the last year that could cause the stock to finally rebound? Well, they took a look at their augmented reality, virtual reality, and they nixed it. All right. What happened to the metaverse? Well, the metaverse has been pushed aside after $8 billion. They decided this just was not worth our investment, and they're pushing more and more back to what got them where they are right now. They're pushing more into AI. So what's working now, what they see working in the future, and I believe that we could see a repeat of what we've seen here 9 of the last 10 years. All right. Take a look at the stock of Meta, and you can see what's happened here since October of last year when it was at $775 a share. What pushed it lower? What pushed it lower was, again, it's a combination of things. AI, all right? The fact that many stocks that pushed their chips in real hard on AI. Well, maybe that wasn't going to be the smartest move, even though AI is a smart move. Maybe everyone rushed to the table a little too soon. And of course, there was that news about the metaverse that didn't help them at the beginning, but I think it's going to help them long term because it's going to shift those dollars back where they need to be. Here's what the money calendar is telling us between now and going into July. right? We see target price, target time, $730. And that's 730 is that number that is between now. That's the 15% of where we are right now. Add tack 15% on the price, and that pushes us up into that area of around 730-ish. I rounded that up between now and getting into the time target that we see there. All right. So there is the projection of beta, and that's what I like to call spotting the opportunity. So spotting the opportunity for me is, like I said, it's one of a few things, but typically seasonality. And so we'll take seasonality, and you can add seasonality to whatever it is that you're using to pick stocks. And maybe that's just another confirming indicator for you, right? If you took a look at what happened with Meta prior to coming into April, huge spike in implied volatility down here as well, which could have potentially offered the turn before we jumped into seasonality. But now we're jumping into seasonality. Maybe the patterns that we saw last year are happening again this year. And if so, April should lead to higher highs for tech stocks. So the next thing I do is, after I spot the opportunity, is can I create an alternative risk trade other than simply buying the stock? Do I really want to buy the stock at $630, right? 100 shares of that, that's going to cost a lot, $63,000. Can I do something that can put me in an area where, based on my target price and target time, that I might have a probability that's going to give me, same probability at the target, but better reward to risk ratio rather than buying the stock? I know if I buy a stock and it goes to my target, that's 15%. What can I do with the options? And what are my risks as well if it doesn't? And that's what creating an alternative risk trade is all about. So if I were looking at, for instance, buying the 700 calls, well, the 700 calls, if they're going to cost me, let's say it's $22, then that's $722 by the time we get to expiration. Well, if my target is $730, then I only have a real expiration return target of $8 when I'm risking $22. That's not much better than buying the stock. And more importantly, my break even on the stock is where I purchased it at $630. My break even on this option would be $722, nearly almost 90 points higher. So is there a better return alternative? Yeah, this is going to be much cheaper. This is where a lot of option traders just kind of fall off the ledge. They go, oh, buying the option is just like the stock, but it's cheaper. No, not when you factor in how much where your break even is going to be. And the break even on the stock is where you buy it. All right. So you have no time decay on a stock. You have time decay on an option, unless you're buying something that's deep in the money and you're trying to get, a lower price. You're still going to end up with maybe hundreds of points for a deep in the money option. We're talking about options near somewhere around the target. Okay. So when I look at this, I look at this target itself. I'm sitting out there and I'm saying to myself, all right, well, maybe instead of buying the $700 strike, maybe I put together, buy the lower, sell the higher. And you're going to hear that come out of me a lot, especially with volatility, with volatility risk. Buy the lower, sell the higher means that we could take in some premium to help pay for the premium we paid for. So, for instance, just off the bat, if I said, if I can buy the 700s for 22 and I could sell the 740s for, let's say, 12. All right. 22 minus 12 is 10. Now I've reduced that down to where that's a $1,000 trade. It was a $2,200 trade, but now it's a $1,000 trade, which means I just cut the cost of the option trade more than in half, and I cut the break even down a lot as well. So if I do that, what I did was I just looked at the seasonality and possibly more on the underlying security Meta. And now I'm creating that alternative risk trade. And if I finally like what I see and I go, okay, this might look good, then what's the final objective here, folks? The final objective is to if you spot the opportunity and you create that alternative risk plan using options, the final thing to do is plan, execute, manage. This is a snapshot of Robinhood. And looking at Meta, what I'd go back again and look at is what are those 700 calls trading for, right? What are those 740 calls trading for, or anything in the middle? You know, I see the 700 calls, they're trading just above 20. I see the 740 calls, they're trading at around 13. I see the 730 calls, or 12, I'm sorry. The 730 calls are trading close to 14. There are some potential, a lot of potential buy to lower, sell to higher, you know, using 740 or 730, for instance, as our targets. If 730 is our target, sell the target, buy below the target, create a lower cost, lower risk trade. That is what it's all about when it comes to spotting opportunity, creating alternative risk strategies, and of course, planning, executing, and managing those strategies. All right, folks. Well, we have come to the end of our session together. But before we roll out of here, all right, questions, comments, you guys are hanging out here on my live stream. I appreciate you being here. And so, you know, as I jump in and I look at comments on the board, I see my supports in the house, as it always is. Jay, good to see you there, my man. Glad you're hanging out here with me. You know, this is an interesting one. Wow. You know, you go back and you look at, you know, Alba's got a really good one. You know, it's funny, man. There's bacteria in the air. And you know why I say that? Because I was just thinking about the same thing and looking at Figma, and I was looking at that price of Figma. And I'm like, wow. If you haven't noticed, you know, Figma was a trade, Fig. And I commented on these particular trading opportunities. And, you know, go back and look at this thing. You want to see something that's just, I mean, just wow. I mean, this thing was at $90. All right. $90 when it IPO'd. And I showed people, you know, how you could get into a stock on a pre-IPO, you know, and this was Robinhood was actually doing pre-IPO. And what did that end up coming in at around? I think it was around $28. I don't remember, because it was what, almost a year ago. And so what ended up happening was the stock jumped on day one, day two. It was the closing high was $122. Since then, look what the stock's done, which tells me I need to go back there and explain to people I don't buy IPOs on IPO day for that reason. The odds are stacked against you. And so here's Figma down here now at the $19.08 level. You know what I haven't done, and I'm going to do this real quick, is that I'm going to look at Figma. I want to look at Figma. And I want to look at Figma on, if I can bring it up here. Here's Figma on the NYSE. And I want to bring Figma up for a reason. This is not even the highs. You have to go back. There's that big high that popped. The high was actually 140. The closing high was 120. The all-time high was, what was it, above $140 a share? Insane. Yeah, 142.92 is what I see on the screen. And I had to squint to see that. But you can see what's happened since then. This is what I want to do. I want to put on the IV. And I want you to see the IV, the implied volatility. This is what the option traders are looking at. And the option implied volatilities went up to around the 120 area, right here in November. That was probably close to an earnings report because it dived after that. Same thing happened here. So the stock dropped to new lows down here down here near 20, and the implied volatility spiked back up to near highs. And then Figma jumped up a bit, about above 30, and then the stock price dropped again. Look, the IVs on the run again, all right? So, would I trade Figma if it was stuck in the 30s? Yes, but probably not the way that anybody would. I'm looking at those IVs. If we get that IV back up here and near these highs again, you get back above 100, then if I were liking the stock, the fundamentals on the stock look good, but this is going to be something that, this is more of an investor than a trader. I'd look at selling long-term puts, on it somewhere down here around the lows and see if there's some premium worth grabbing there, because what does that do for you? That allows you to get access to the stock at below market price and get paid for it. That's something you might say, well, that's going to cost me as much as the stock. If you're looking at buying the stock, at these levels, then all that does is lower the price even more and give you a higher probability. I do that with a couple stocks. I'm in a stock right now. I can't say what it is because I don't want to induce trading on it. But the stock's a cheap stock right now. It's cheaper than it was when I sold put options on it for the first time. But if I would have bought the stock at the price that I sold the puts at the time, I'd be much more down than I am right now. In fact, I'm actually looking at selling more put options and lowering that break even, right? Which is not bad. I'm not off what the stock traders are off, and I like this particular stock, right? But that's how I would treat a Figma. So thank you for asking. It's great question. Sorry I'm late. That's okay. You get the on-demand session. All you got to do is just pop it up in the recording. And of course, good to see all of you as well as we kick out of here. Once again, guys, for those of you that just joined me, I'm going to be dropping 3 stocks, my spring breakout stocks. I'll be dropping them in a video later this week. So if you're not a subscriber already to the channel, then do yourself a favor and get that subscription. You'll get that before everybody else does, because my subscribers will grab that long before anybody else sees that. And then, of course, I've got reports, and I've got a report on the oil pattern. And if you want that report, then what you want to do is you want to hop on over to patternsandprofits.com, right? www.patternsandprofits.com. And you'll see the reports, and you can grab that report. It's absolutely free, and it will discuss with you not only stocks that I see going higher in oil, but stocks you want to avoid, right? Stocks that you want to avoid right now. And I might even put something out here soon on those top 3 that I'm avoiding as we move further into spring. All right. Hey, thanks for joining me. Have a great rest of your day, and I'll see you again here real soon. Bye, everybody.